Hey guys, Stockaholics. Thank you guys for being here today. It's been a little while since I've made a video, but I thought I wanted to come back, talk a little bit about bookers. It's something I've been meaning to expand upon for some time. In this video, I'm going to be talking about rates, what's driving them, what's going on, China, some of my thoughts, some patterns that you notice in the industry, and ultimately what I'm thinking or what I might be doing in the space. All right, let's start. Let's take a look at the Baltic Dry Index. If you don't know what this is like the cumulative average earnings of the entire bulker segment. Um, what we're looking at here is a chart going back 30 or so years since the 90s. I wanted to point out a few things from here from 2003, 2008. It's a tremendous spike in earnings for several years. This was largely categorized by strong demand that came from primarily China, but some other places in the world. However, what happens in all of these cyclicals and every shipping segment, when times are very good, these guys go out and they order a ton of ships. What that led to after the global financial crisis is the same level of demand wasn't really there, and at the same time you had just an absolute ton of ships coming and hitting the market. Since then, that's led to a decade or so of really poor earnings. So, and if you've been invested in this space, you probably since that period you probably have not done very well. However, a lot of that started to change since the lockdowns that took place last year. At first there was the looked like there was not going to be a lot of earnings taking place in dry bulk and in any shipping segment as people were stuck at home. But what we started to notice is that there was a lot of synchronized stimulus going all around the world from different governments and a lot of demand for goods that led to tremendous amounts of earnings in the container ship segment. Some of that has actually bled over into this segment, not only from an increase in production of certain goods, which a lot of people were going out and purchasing, but also because there's something interesting I heard of is that where there was actually dry bulkers that are actually holding containers as well. So some of that has bled into the dry bulk segment also. We also know that we've seen a big surge in different prices of commodities. That's led to ton-mile demand increases as people tend to source commodities from different places. A lot of different factors on what could have caused this surge. What we've seen recently, however, is that there's been a huge drop, about 50% or so in the DBI. One pattern, though, I'd like to make a point of is that every time in the past when we've had a big spike that's gone, above 4,000 or so, or even above 3,000, these have never been in solitary spikes. There's always been one that has come right after it as well. Just something I've noticed. I don't know if this one will be different than the ones prior, but that is an observation that I had when looking at this. By the way, I think those double spikes have a lot to do with the behaviors that you see in commodities. A lot of commodities there are what are referred to as double tops, where they hit a peak, they go down a certain point, hit another peak, and then finally mean revert. We've seen a lot of commodities, however, that haven't done that, like iron ore, and I think what's starting to happen now is coal, where they just have nosedives. So if that has anything to do with dry bulk rates, there's a possibility that those go straight down. But we've also seen some other commodities like copper that have been somewhat resilient in their pricing. Now, I wanted to make a point of this. This is one dry bulk segment, or not dry bulk, a dry bulk company, Golden Ocean Group. I don't have any particular strong opinions for or against any dry bulk company. Just thought I'd share this one. And what happens in these cyclicals, especially in shipping, when these companies go through periods of large amounts of earnings, their share price tends to appreciate. Flip side is true too. When share prices are rates start to go down, so do share prices. And I've seen a lot of market euphoria in container ships where people try to think that it's going to be different this time for container ships. I would suggest that it never is. And if you hear analysts that are saying something otherwise, you might want to question that analyst's integrity, because they're probably selling you their book. All right, I wanted to take a look at a couple of commodities to kind of show you how the prices of these commodities tend to correlate very strongly with the earnings that bulkers tend to make over time. So this is iron ore and this is coal. And you can see that based on this chart that these two segments make up a big amount of the different segments in the bulkers, the different sizes of these vessels, right? By the way, one of the things I hear a lot about in all shipping segments, by the way, is that you see these companies that are maybe they're only involved in, super maxes or handy sizes, and they'll say, oh, well, our segment's different because our vessel is a more niche segment. Same thing you see in tankers, where you have the product tankers say, well, we're special because we carry product, and the crude tankers are like, well, we're special because we carry the crude oil, right? I don't think of shipping at all like that, because there is a lot of interplay that happens between all of the different segments, even the different within a segment, but even within different segments, by the way, like I mentioned, where we see container ship demand bleeding over into the bulkers, right? So the way I think about shipping in general is just overall supply and demand. And now demand can be really hard to predict. Supply is a little bit more predictable, but I'll show you guys that in a second. So I don't really buy into the narratives that particular segments are more niche. They're more, they have a wider moat compared to others. As you can see here, there's a lot of interplay between all of the segments. So anyway, I wanted to show you iron ore and I wanted to show you coal, because these two are probably one of the two bigger segments for the overall dry bulk seaborne demand, right? Now, iron ore, it went through an absolute tear in prices. Again, this could be from stimulus. It could be from in the Western and Eastern world. It could be from infrastructure demand. Could be for a bunch of different reasons. But as prices went up, so too did demand for the dry bulk, their prices and the DBI, right? And a lot of the reason for this is because as the prices tend to go up, people tend to source the commodity from different locations in the world, and those locations might be a lot less efficient in terms of ton-mile demand than when prices are very low. Same thing has happened with coal. Coal went on an absolute tear, but just like iron ore has been gone on an absolute cliff. I would imagine that this is probably going to keep going down, like most other commodities that have had this sort of pattern, and at least go down to probably the upper range in terms of pricing. Likewise, it seems like since coal is a big portion of this segment, the chance that at least in the short term that we see a big uptick in the DBI is somewhat unlikely. I wanted to share this little snippet from a conference call from Starbuck Carriers Corp. First of all, when we are listening to these executives of shipping companies, we must always take what they say with a very large grain of salt. They are very interested in keeping things as rosy as possible, no matter what the market looks like. But there is some other different ways that you can think about some things, and I thought I would share those with you because I thought they were interesting. So this is a question from somebody. Thanks, operator. Hi, everybody. Hopefully you can hear me. I had a couple of questions. First, maybe a market-related question. We've obviously seen a pretty significant step down in spot rates. I think, Petros, you mentioned that congestion. Now, these guys also later go on to talk about this congestion. One of the things that I've seen from different sources is there really hasn't been all that much congestion. The rates of dry bulk congestion is nowhere near the rates of congestion we've seen with container ships. Rather, what's really most likely been driving the dry bulk's rates is actually just sourcing the demand, the ton mile demand for commodities from much longer haul routes. You can also think of this spat that's going on with China and Australia in terms of iron ore demand. Sourcing that iron ore from other places in the world increases the routes that these guys have, these dry bulkers have had to carry these things on tremendously, right? So there is a small amount of congestion, but based on the data I've seen, that's really not likely what's contributing largely to these increases in rates. I was wondering if you'd give us a little bit of an overview of what you're seeing on end market demand growth in China. Obviously, there are some emission mandates. There's the Olympics coming up. What are you seeing in terms of risk associated with demand there? So this Olympics discussion, basically, because the Olympics are coming up, at least what China did last time, what they're doing this time too, it seems evidence would suggest, is that they shut down a lot of their industries, at least near where they're going to be having the Olympics, because they want to have the sky nice and beautiful for when everybody comes to compete for the Olympics there, right? And basically it shuts down a lot of that commodity demand in the short term. What are you seeing in terms of risk associated with demand there? And he also asked a little bit about maybe what is their psychology driving some of these rates too, which might be possible because if you've seen there's a lot of negative sentiment about the real estate sector in China as well. And I guess it's not this guy who's responding, but actually Petros. Thank you, Amit. It may take me a little bit longer to answer your question. First of all, the market is down for three reasons. China, China, China. I might go into this in another video, but a tremendous amount of demand for commodities comes from China, as much as 50% for some types like coal and iron ore, which is what we remember from those other the breakdown of the dry bulks, the different sizes of the ships. They carry a lot of this stuff, right? Okay. And to explain further than that, we had a strong steelmaking reduction to the tune of 20%, almost in the last couple of months, which is obviously negative for imports. And of course, it also affects congestion. It reduces congestion. We saw China increase their local production and capping prices, so therefore less import. Actually, imported coal is more expensive than local coal, so that might reduce demand for some of that coal coming from other routes. We saw before that higher commodity prices basically led to a certain demand destruction, at least in the short term. So eventually the prices of those commodities, people stop buying them. High prices is the cure for high prices, right? And China basically wanted clear skies for the Olympic Games. So it's a combination of clear skies and reduction of commodity prices from China. That's what their goal was. But let me make a side here, which I think is important. I was going through the imports of China earlier today, and I realized that in 2022, China, 2021, in the last 10 months of 2021, China actually imported 2 million tons less than last year. And you remember what they all used to say, that if China sneezes, we will catch an pneumonia. The market will catch pneumonia. Well, China sneezed, and we didn't catch exactly pneumonia. So I think that happened because the rest of the world came up. And when we're talking about 4% increase in import in trade in 2021, actually that's about 180 million tons of additional trade. All of it came from countries other than China. I consider this as extremely important, and especially for the future. Now, talking about the future, we are very positive, as all shipper executives always are. Actually, we remain very positive. We think there's going to be a slowdown during the Q1 for the reasons explained. We think that the market will start moving after the Winter Olympics. We foresee very strong grain trade coming from Brazil and to a lesser degree from Argentina. We think that coal prospects are pretty good, especially from India. Now, there's a lot of talk right now about China, and there's a lot of people that suggest that the growth that we've seen in China over the last 20 or so years, that might come into question, especially with the real estate situation that's going on too. But I think what always kind of happens is that maybe where there's a lack of growth in one place in the world, there is also the possibility of growth in other parts of the world, right? So although there might be a tremendous amount of demand for commodities coming directly from China right now, it is important to think about where that demand might come from in future years. I know that there's a lot of countries in Africa and South America that are really just starting to hit their S curves. And if we think about that in terms of commodities demand, it means that they're in the future, at least when you're talking 10 years out into the future, the likelihood that you see an increase in demand for seaboard trade of commodities overall, in my opinion, is very likely to increase rather than stagnate or stay the same, no matter what happens into China. Yeah. But China having achieved their goal, will probably turn to more imports. As I said before, international prices are cheaper. Iron ore. China imported 38 million tons less of iron ore this year in total. We think that will change going forward, and we think that a lot of it is going to come from Brazil. So we expect more ton miles, which is going to be positive, very positive. Actually, ton miles are more important than whatever you decide to say after that. I wanted to mention there's a lot more I could talk about in dry bulk. I had a lot more slides. I think I'll make another video talking about all of those things. But I guess for this video, I wanted to maybe leave it at this. And there's a lot of talk about what's going on in China right now. There's a lot of anticipation in terms of demand, what's going on in China. The real estate market is, people might think it's collapsing. I don't really know. It might be. But there's one other thing that I don't think that anybody really talks much about, and that is seasonality in commodities and in terms of seaborne demand for those things, right? Now, this is a chart of the seasonal pattern for different dry bulk segments. There's periods of time in the year when those rates tend to get lower, and there's periods of time during the year when those rates tend to go up. The biggest volatility you see in those is from the largest segments, and this is actually something you see in most shipping segments. There's a lot more volatility in bigger ships. But during the winter months, there's not a lot of dry bulk imports. There's a lot less demand and rates tend to go down. There's probably some reasons for that. I don't exactly know what they are, but I know that the seasonality exists in every segment. And so for as much fear and talk about potential demand destruction from China in the coming years, it might just be seasonal patterns. I'd like to hear some of your guys' opinions on some of that. But I'll leave it at that. I hope you guys have a great weekend and see you guys soon.